The world of finance is standing at a major crossroads. For centuries, traditional banks have been the undisputed pillars of our global economic system, controlling the flow of money with centralized authority. However, a powerful new force has emerged, one driven by cryptography and distributed networks. This force is cryptocurrency, and it is not just an alternative asset. It is a fundamental challenge to the very structure of banking as we know it. The introduction of Bitcoin in 2009 planted a seed of change that has now grown into a sprawling ecosystem, forcing a profound transformation upon the established financial order and promising a more open, accessible, and transparent future for everyone involved. At the heart of this revolution is blockchain technology. Think of it as a shared, immutable digital ledger. Every transaction is recorded as a block and added to a chain that is duplicated and spread across a vast network of computers. This decentralized nature means that no single entity, whether it's a bank or a government, has total control. For digital banking, this is a game changer. It offers a way to conduct transactions that are not only secure but also incredibly transparent. Anyone on the network can verify the transactions, which drastically reduces the potential for fraud and eliminates the need for many of the intermediaries that currently slow down and add costs to traditional banking services. The impact of this technology extends directly into the core services offered by banks. Crypto banking is no longer a niche concept, it's a rapidly growing sector. People can now open savings accounts that hold digital assets like Bitcoin or Ethereum, often earning interest rates that are significantly higher than what traditional banks can offer. Furthermore, crypto payments are becoming more mainstream. They allow for near instantaneous transfers of value across the globe, bypassing the slow and expensive correspondent banking system that has dominated international finance for decades. This is not just a minor improvement, it is a complete reimagining of how money moves. This shift represents more than just a technological upgrade, it is a philosophical one. Traditional banking operates on a model of trust in institutions. You trust your bank to hold your money, process your payments, and act in your best interest. Cryptocurrencies, on the other hand, operate on a model of verifiable truth. You don't need to trust a third party because the system's integrity is guaranteed by mathematics and code. The blockchain provides a single source of truth that is open for all to see. This fundamental change is forcing banks to reconsider their role and value proposition in a world where trust can be programmed and automated, not just promised. The most radical expression of this new financial paradigm is decentralized finance, or DeFi. It takes the core principles of blockchain and applies them to a wide range of financial applications, from lending and borrowing to trading and insurance. DeFi platforms operate as peer-to-peer networks, connecting users directly without any middlemen. Imagine obtaining a loan not from a bank, but from a global pool of lenders, with the terms enforced automatically by a smart contract. This is the power of DeFi. It creates a financial system that is open, permissionless, and resistant to censorship, fundamentally altering the power dynamics of modern finance. A key component enabling this new ecosystem is the stablecoin. These are cryptocurrencies designed to maintain a stable value by being pegged to a real-world asset, most commonly the US dollar. Stablecoins like USDC or Tether or USDT solve the problem of volatility that makes cryptocurrencies like Bitcoin impractical for everyday transactions. They combine the best of both worlds, the stability and familiarity of traditional fiat currency with the speed, low cost, and global reach of digital assets. They are proving to be especially effective for cross-border payments, allowing individuals and businesses to send money internationally in minutes, not days, and for a fraction of the cost. The implications of DeFi and stablecoins are enormous. They are building an alternative financial system that runs in parallel to the traditional one. This system is accessible to anyone with an internet connection, regardless of their location or economic status. For the billions of people who are unbanked or underbanked, DeFi offers a direct entry point into global financial services, a possibility that was previously unimaginable. It empowers individuals by giving them full control over their own assets, a concept known as self-custody. In this model, you are your own bank, holding the private keys to your digital wealth and making decisions without seeking permission. This rise of a parallel system creates immense pressure on traditional banks. They are no longer the only option available to consumers and businesses. The efficiency, transparency, and accessibility of DeFi protocols are setting a new standard for what financial services should look like. Banks must now compete with a global, automated, and constantly evolving network that operates 24/7. This competition is forcing them to innovate faster, reduce their fees, and improve their customer experience. The very existence of DeFi is a powerful catalyst for change, pushing the entire banking industry toward a more user-centric and technologically advanced future. Governments and central banks have not been idle observers of this crypto revolution. They have recognized both the potential and the threat posed by this new technology. In response, many are actively exploring the creation of their own digital currencies, known as central bank digital currencies, or CBDCs. A CBDC is a digital form of a country's fiat currency that is a direct liability of the central bank. Projects like China's digital yuan, or eCNY, are already in advanced pilot stages, while the European Central Bank is progressing with its digital euro project. These initiatives aim to modernize payment systems and maintain monetary control in an increasingly digital world. The development of CBDCs signals a major acknowledgement from the highest levels of finance that the future of money is digital. However, a CBDC is very different from a cryptocurrency like Bitcoin. While it uses some of the same underlying technology, a CBDC is centralized by nature. It is issued and controlled by a central authority, which gives that authority significant power over the flow of money. This approach seeks to capture the efficiencies of digital payments without giving up the control that cryptocurrencies challenge. The global race to develop and launch CBDCs is set to become a major theme in geopolitics and international finance over the next decade. As cryptocurrencies and digital assets become more integrated into the global financial system, the issue of regulation has become paramount. Governments around the world are grappling with how to create rules that protect consumers and ensure financial stability without stifling innovation. This is a delicate balancing act. Regulators are focusing on key areas such as anti-money laundering, or AML, and know your customer, or KYC requirements, which are standard in traditional banking. The goal is to bring the crypto industry into the regulatory fold, making it a safer and more predictable environment for both individuals and institutions to operate in. Security is another critical piece of this puzzle. The decentralized nature of cryptocurrencies presents new security challenges that differ from those in traditional banking. While the blockchains themselves are highly secure, users must be responsible for protecting their own private keys. Exchanges and other centralized platforms have also been targets for sophisticated cyber attacks. In response, the industry is developing more robust security measures, including multi-signature wallets, hardware security devices, and advanced cryptographic protocols. Integrating these new security paradigms with existing banking infrastructure is a complex but essential task for building a resilient digital financial future. Faced with this wave of disruptive innovation, banks are not standing still. Instead of fighting the tide, many are choosing to adapt and integrate crypto into their own service offerings. Major financial institutions that once dismissed cryptocurrencies are now building out their own digital asset divisions. They are beginning to offer services like crypto custody, allowing wealthy clients and institutions to securely store their digital assets. Some are also facilitating crypto trading for their customers and exploring the use of blockchain for streamlining their own internal operations, such as trade finance and settlement processes. This marks a significant shift from rejection to adoption. This adaptation creates a fascinating duality of opportunities and challenges. The opportunities are vast. By embracing crypto, banks can tap into a new, fast-growing asset class, attract a younger and more tech-savvy customer base, and enhance the efficiency of their services. They can leverage blockchain technology to reduce costs and create new revenue streams. However, the challenges are equally significant. Banks must navigate a complex and evolving regulatory landscape, invest heavily in new technology and security infrastructure, and retrain their workforce to understand this new financial world. The cultural shift required to move from a centralized mindset to one that embraces decentralization is perhaps the biggest hurdle of all. Ultimately, the future of banking is unlikely to be a complete replacement of the old system with the new one. Instead, we are heading toward a hybrid model where traditional finance and crypto finance coexist and interconnect. Banks will likely serve as crucial bridges, providing on-ramps and off-ramps that connect the fiat world with the digital asset ecosystem. They can offer the trust, regulatory compliance, and customer support that many people still desire, while leveraging the efficiency and global reach of crypto networks behind the scenes. This blended approach could offer the best of both worlds for consumers. The crypto revolution is fundamentally rewriting the rules of global banking. It has introduced new technologies, business models, and philosophies that are forcing a period of unprecedented change. From the disruptive power of DeFi to the official response of CBDCs, the entire financial landscape is being reshaped. As banks continue to adapt and innovate, they will play a key role in shaping this new frontier. The journey ahead will be complex and filled with challenges, but it promises to lead to a more open, efficient, and globally accessible financial system for generations to come.